Hi, everyone, and welcome to the Amber Data Derivatives Podcast. I'm here with Arisa and JP. Arisa is from Cega, the DeFi options protocol focused around exotics. And JP is from Tras Mobian, which is going to be a market maker who is focused mostly on Cega. Guys, how are you?
Yeah, we're good. Thank you for having us today. Super excited to chat about Sega.
Absolutely.
Hey guys.
Hey, JP. So my thinking was we could maybe start around your guys' backgrounds. Kind of what did you do before getting into crypto? What did you do before Sega? And maybe we could start with you, Arisa.
Yeah, absolutely. So my name is Arisa. I'm the co-founder of Sega. And Sega is a DeFi protocol that focuses on creating exotic options on smart contracts. My background is actually in computer science and economics, which is the degree that I studied back in university. And then out of university, I went into doing derivatives trading in New York and Hong Kong. Afterwards, I actually made a career switch to being a product marketing manager at Google. And kind of, within those experiences, I realized that my passion lied in the intersection of tech and finance, but I also was like, okay, I literally just did derivatives trading, which is one of the most quantitative fields in all of finance, and I did product marketing, which is a very emotional, a very like art focused field. Like, how do I combine the two? And then I was looking into DeFi in the summer of 2020, and I saw that option space was a huge opportunity. And specifically, my specialty was in exotics, and I realized that no one was doing exotics. So I wrote the white paper for Sega in November of 2021.
That's fantastic. And when you say that you did some specialization in exotics, like what was the most attractive point for bringing that into crypto? So, I mean, this is the most complicated version of derivatives, which are also very complicated. So, what made you think like there's a good opportunity here for these types of assets that are not too complicated for DeFi degens and so on?
Yeah, absolutely. Actually, exotics is probably a lot larger of a market in traditional finance than a lot of people think. So, a lot of private wealth management products are actually combinations of exotic options. And when you hear the word exotic, it sounds kind of complicated and scary, but really, exotics just allows for more flexibility in the way you can take positions in the market. And so it actually allows you to construct products that could be much lower risk with a good amount of rewards, or you can make things that are higher risk with high rewards. But what what exotic options do, it's a condition on top of vanilla options. And by adding a variety of conditions, you can express your view in the market in like infinite ways. And it's such a cool field, and not a lot of people know about it because the math behind it is quite complex. But the actual utility is so strong. And in traditional markets, if you're a client at a private bank, you actually get a lot of exotic option products sold to you, but they're just not mentioned as exotic options. So those are kind of the ways that it exists in the real market. I realized that a lot of the wealth management products in crypto were actually fairly risky products, and I wanted to create products that had a safer but a good yield in volatile market environments. And so that's where the idea of Sega came from.
Yeah, that's fantastic. And JP, what about you? Can we jump into your background and how you got to where we are today?
Yeah, for sure. So I graduated quite some time ago out of an engineering school, and I have a master's in applied mathematics and financial modelization. And I actually started working during a crisis in 2006. So it took me a couple internships before landing a permanent position as a trader. And since then, I've traded various derivatives in several asset classes, namely commodity and equity derivatives. I've done that out of Paris and New York. And I put an end to my TradFi career in 2021 when I moved on to crypto to join a couple of friends in a trading house. And I just recently joined Sega the past summer to help build the next generation of exotics in DeFi.
Cool. And then when you were trading vol in sort of traditional assets, what kind of contracts were you trading? Like regular future options? Were you trading as a proprietary trader? Or were you also in exotics and trading as like a principal trader or something like that?
Sure. So when I started my career, there was a bit of a mix between proprietary trading and principal trading. Everybody kind of did both. But then, because of regulation, it had to be separated. And I was a principal trader. So most of my career, I was an exotics trader, but I also traded vanilla and electronic trading. So I would trade, just any derivative, futures, options, and more exotic stuff like correlation product in the interbank market.
Fantastic. And so, a lot of recent grads and people would like to have careers like you guys had started in derivatives markets at banks and stuff like that. Is there like some lessons that you learned along the way that you would tell your younger self, or any advice that you would give to like a newer recent grad who wants to follow a path similar to your early career?
Sure, I can
Sure.
maybe take a stab at this from a DeFi protocol founder's perspective. I think so I angel invest in my own time, and a lot of projects that I meet, or a lot of founders that I meet, they seem to not have a good idea, but they're very eager on becoming a founder. And I think the number one advice for people looking to be in DeFi is to try to find a good problem to solve. Like that's something I think not a lot of people actually think about. They think about kind of the short-term game, and they kind of end up like forking protocols or creating schemes that don't actually generate real value. And I think the important thing is to play the long game, be a good person, find a good problem to solve, and develop products that people actually want.
Yeah, that makes a lot of sense. And that's something I also kind of discovered as well. It's like, as a founder, having a good skill set takes a long time to build. And so once you have a good skill set, like you guys had as well, like you can apply that into this new space where no one else has before. It's kind of like that's the problem. You have the skill set to do it, and then you could do it as opposed to just jumping in with a fork company, like you said. That's very interesting. How about you, JP?
Yeah, so obviously my career is a bit different than Arisa's, and I've been like an hardcore expert in exotic derivatives for 15 years. And in a trader, what you're looking for a candidate is obviously impeccable academics, because that demonstrates the ability to not make mistakes. And when you're looking for a new trader, you want someone who's not going to make mistakes, because mistakes are pretty often very costly. So we really put an effort on avoiding them. And also, a lot of candidates have difficulties with transitioning from the academia to the workplace, in the sense that they're not focusing enough on usability and actual value added rather than theory and just studies. So for me, what made a difference is that I really was not settling for understanding the basics of things, and I really wanted to be able to have a conversation and challenge the most senior traders I was working with, and that's really how I stood out. So that would be my advice.
Interesting. So getting good grades. And would you say that math versus computer science, is there a preference, or you need both?
When I started, I would say that math was definitely the go-to. Now I would say that you at least need to be good at Python, or good enough that you can implement your own ideas. You don't have to be a hardcore software engineer, but you need to know your way around Python.
Cool. So maybe we could jump into a little bit of Sega. So when you guys launched on mainnet, what kind of adoption did you guys see? What were some of your initial products? What kind of feedback did you get?
Yeah, absolutely. So Sega launched on mainnet on Solana in May of 2022. And then we are also launching on mainnet on Ethereum very soon. So
Cool.
that's super exciting. When we launched on Solana, it was during a very exciting time in the market. And we actually saw a huge number of users and TBL come into Sega on the very first day. We made a pretty big splash with like our news and the white paper that came out like half a year before that. And then when we launched on DevNet, we received really good feedback. And so when we launched on mainnet, we kept on selling out for like the first like 2 or 3 weeks. And then things obviously like papered a little more. In terms of TVL, Sega was like number 2 across all chains and number 1 on Solana. I think that is still the case today, although the overall volume in DeFi has definitely gone down. And yeah, in terms of our product lineup, Sega has 8 products currently, and we're looking to expand this even more. Every single product is a similar structure. So it is a worst of put basket selling strategy with a knock-in barrier on the downside. So what that means is if you are staking into a vault that has a BTC worst of basket, that means whichever one BTC or ETH is like trading below versus where like 100% like at the money is, that's the one you count towards the overall position. And so if you are staking into our starboard strategy, for instance, you're basically saying that in the next 27 days, you don't think BTC or ETH is going to drop more than 50%. And if that is the case after 27 days, you get anywhere from like 10% to 15% APY. It's a super awesome product because in vanilla options, for instance, if the market moves 5% in the way that you don't want it to move, you lose money. But in like exotic options, especially the ones with knock-in barriers, you're basically saying that as long as the market doesn't fall to this particular level, you don't have to worry about your principal losing. And we have this knock-in barrier covering anywhere from 30% to 90% of the market movements. So if you're extremely conservative, you can basically stake into a vault that says, okay, in the next 27 days, I don't think BTC or ETH is going to go down to $2,000 or $200. So that's generally the kind of products that we offer, and we've heard great feedback. So a lot of our users really enjoy the fact that we have knock-in barriers in our products, and a lot of our users are quite engaged with all of the new products that we come out with. So we've seen great feedback, and if anyone watching this tries out our product and has feedback, we have super open ears on our Discord. So there's a channel called User Feedback. We're very active on it.
That's fantastic. And now, in your earlier iteration of your product, there was a lending component as well to sort of the capital that was tied up. Can you maybe touch on that in a new iteration? And maybe we could jump into sort of the FTX fiasco and how your guys' protocol did during that.
Yeah, absolutely. So what Sega's products were at the very beginning were something called a fixed coupon note, but that was partially funded. And partially funded means the FCNs were actually a combination of bond and an option. So a part of what you staked were actually lent out, as well as taking the options position, which is the worst of put basket with the knock-in barrier. What Sega was doing was working with protocols such as Credora or Maple Finance to do counterparty KYC, as well as to understand the risks of the counterparty balance sheet. We thought the market was ready for levels of under collateralized lending, but the FTX Alameda fiasco had definitely made us realize that the markets are still very nascent for the level of under collateralized lending that we thought the market was ready for. And so we've basically created V2 of Sega's products that only focuses on options. And it does not have any sort of a funding element. So now everything is 100% collateralized on chain. And you can even track the addresses that the collaterals are being stored in. And so your funds will never be lent out.
Very cool.
In terms of, and yeah, thank you. And in terms of the whole FTX Alameda fiasco, so one of the things that Sega was lauded for in the market was that we were kind of the market leaders and market thought leaders in implementing a lot of these risk management systems for counterparty risk management. And so, we mentioned working with protocols like Credora to do counterparty risk management. But not only that, we actually made sure to sign these legal documents called International Swaps and Derivatives Agreements. They're called ISDAs. ISDAs basically has clauses that allows for early terminations of trades in case there is financial volatility on the counterparty side, and it basically allows for early settlement and early redemption of any sorts of trades that are going on. And so in the FTX Alameda fiasco, we enacted our ISDA clauses with Alameda and a few of our other counterparties, and we were able to get 100% of all of our funds back
Wow.
before any of the news came out.
That's amazing. So ISDAs are a very TradFi thing, OTC counterparty protections. You guys are doing the same thing, but in the DeFi space, and you actually got counterparties such as FTX to sign on to agree to that, and you're able to save some funds by enacting those clauses. Did I understand that right?
Yes,
Wow,
exactly. So
nice.
we take 100% of our user funds from any credit risks that were present in the market during the FTX Alameda crisis. And then on top of that, we also, we basically are the only DeFi protocol ever to, I think, have ISDAs. And this is because I think the market is definitely doing a lot of experiments for decentralization, but there's still a lot of problems to solve. And I think one of these problems, like a lot of these problems to solve, I think, should have backups. So for instance, for like smart contract risks, I think there should be like insurance that DeFi protocols are in. I think for things like credit risks, there should be ISDAs, and there should be like balance sheet checks that are being put into place. I think a lot of the risks that people talk about DeFi can actually be mitigated by creating processes in place that may not be fully decentralized from day one, but I think it protects all the users from using your platform.
That's really interesting. I mean, that just really shows a lot of experience. Like a lot of people think about VAR risk or price risk, and you guys are thinking about operational risks that people are overlooking. And I mean, those are huge sources of risks when they hit. So that's cool. That's very interesting. JP, from a market maker's perspective, what are you doing when you got to essentially take the other side of flows like this? You know, what's sort of your process? Where do you offset risk? Stuff like that.
Mm-hmm. Well, the idea is basically to have a correct modelization of the product you're trading, and that correct modelization combined with a financial model is going to give you measures for risk, and these measures for risk naturally will tell you what is the right hedge. So for an exotic product, it can get a little more complicated than that, because the definition of an exotic product is something that does not have a static hedge. So you have to hedge and rehedge and rehedge. So that's the definition of an exotic product. But if your product is correctly modelized, then it's fairly obvious what you need to do day after day. In our case, since the product is a knock-in put, and the risk is obviously on the downside for our clients, well, for us, the hedge is obviously to be selling some sort of put on the downside on the underlying products. So if I end up trading on the market maker side a product like Starboard, which is 50% protection on BTC and ETH at 27-day tenor, then in that case I would probably go onto whatever exchange that's available to me to trade BTC or ETH options and trade a combination of that in order to hedge the risk and have, say, at least the directional risk and the general volatility risk of the product correct on day one and hedged. And then a day after or a couple of days after, I'm going to probably do the same process again in an iterative way.
Yeah, that's interesting. So one of the things that I find really interesting about crypto vol is that it sort of hasn't been figured out yet. We've seen a lot of different surfaces throughout the past few years. you have experience in equity vol, you have experience in commodity vol. Does that background help you at all? Is there sometimes you're saying, okay, like this looks like it's priced similar to what index equity index vol would look like, or that surface would look like, and now it's similar to say some commodity, or is it completely different, or do you look at that at all?
Yeah, obviously, I use my experience in that. And for instance, let me give you an example. If you realize that Bitcoin is very correlated to equity markets, but the volatility surface of Bitcoin is very different from the volatility surface of S&P 500 or something like that, then probably something is wrong. And would you say S&P 500 volatility surface is wrong rather than Bitcoin surface is wrong? I mean, I don't know. There's a lot more eyes on S&P vol surface than BTC vol surface. So there's probably something to do on the BTC side to compensate for that discrepancy. So the obvious remark you could say is that, for instance, price for protection, so the price for put options on the crypto side, is not as expensive relatively compared to price for protection on the downside on the equity side. So that's probably something you want to look at.
Yeah, that's interesting. We just released a report analyzing some of this stuff, and that was something we noticed. Like throughout 2022, BTC and equities are pretty correlated. Puts are skewed on the equity side, meaning puts are more expensive than calls. And then this year, so far, we've seen calls are more expensive on the BTC side. So you can sort of combine those, and now you got something that looks pretty nice. Yeah, that's very cool. And then kind of just one more question here. Are you seeing like certain trends in crypto vol that you find interesting? So, for example, what we've seen in the past few years for like the basis trading was something that seemed pretty attractive and had some pretty decent yields to it. Last year, not so much, but we've seen sort of a consolidation in that trend. Is there something, without giving out alpha, that you find interesting going on in the crypto vol space?
Yeah, I mean, the obvious thing would be to say on the vol side that the trend is going lower for the implied volatility general level. But I'm not. I mean, you're not going to learn anything by me saying that. I think the idea is that blue chip coins, BTC ETH, are behaving more and more like traditional assets. We're not there yet, but we're tightening the gap, and this means lower volatilities generally. This also means probably higher put skew on crypto than we have right now, just to look more like traditional assets, more investment grade traditional assets. Now, I could go more in detail, and not at the risk of disclosing alpha. I just don't want to lose anyone. But I think that there is definitely something to say about comparing protection on the upside to protection on the downside, and the effect that adoption of options as a hedge will have on the looks of that vol surface. Let's just say that, for instance, if you're a Bitcoin miner and you want to hedge your Bitcoin production, then maybe a good idea is to try and sell call options to hedge your production. And even though some miners are already doing that, I think there's a lot still to do in terms of adoption. And once we have that type of flow, but not just this one, but that type of flow on the volatility surface of crypto, there's going to be a significant change in the volatility surface.
Yeah, interesting. When there's like the systematic sellers of calls that you might see in portfolio managers and equities, that'll help shape the surface in a more consistent manner. That's very interesting. And then, Arisa, one of the things that we saw for DOVs, like when we had the Luna fiasco, there were some players who were making DOV markets on Luna, and obviously that was kind of a big tail risk that wiped out a lot of people. When you think about products on altcoins versus blue chips, what do you guys think about that, or think there? Are you guys just going to stick to blue chips, or is there an idea of going to altcoins, or how do you think about it?
Yeah, definitely. I actually think using blue chips will probably be our primary strategy in the long term, and I think this is just in general like a good thing to do. a lot of altcoin vols have liquidity issues, and especially in the times like Luna, the people who invested in Luna vanilla put selling strategies lost a lot of money, and the purpose of Sega is to try to create risk managed vaults that are yielding good returns for our users. Obviously, there are risks to staking into exotic option vaults, but we never want to create products like Luna put selling strategies. And I think in terms of bull market liquidity, though, with kind of a lot of protocols that are now spinning up to try to increase the bull market liquidity, like all these like LP rehypothecation protocols like Canoptics, Gamma Swap. I think there's also a lot of institutional market makers now looking to enter the bull space. I think as liquidity becomes much larger in the market, we can probably start looking at top 10 asset classes. But until then, I think we're going to stick with blue chips. And the beauty of exotic options is that you can still create so many different types of products using the same underlyings, just to show a variety of risk rewards and benefits.
Yeah, that's very cool. So I can't finish this podcast without talking about the cool logos that you guys have at Sega. So I used to be a huge Sonic the Hedgehog fan when I was a younger kid. Sega all day over Nintendo. Now I've switched a little bit, but back in the day, Sonic was my thing. So is Sega Genesis part of an inspiration for Sega Protocol, or is it completely unrelated?
It is completely unrelated, although the name Sega is actually a derivative trading term. So our products are basket options, and basket options basically have correlations of underlyings. And so a part of the inputs for pricing our products is the correlation between Bitcoin and Ethereum, for instance. And the P&L that is driven through correlation is actually tracked through a Greek called Sega. So that's where the name for Sega comes from. A lot of our marketing is also community driven, and I think people might have associated the name Sega to gaming companies, and I'm Japanese, so I think there were probably memes that were driven through our community, but we have no association to the gaming company.
Cool. And then you guys actually have an NFT in the market, which enables you to trade certain products and potentially different fee structures. Is that right?
So the NFTs were developed as a part of our Sega mainnet launch. It was to try to experiment on whether we could help the NFT crowd also learn about DeFi, and to avoid risky products and to try out products that are interesting on the DeFi side. A lot of people on the NFT side only focus on NFTs and haven't really done staking before. A lot of people on the DeFi side, are not huge fans of NFTs. So we wanted to see if we could really bridge those communities through our NFT project. And then we also wanted to make sure that the NFTs had utility. And so some of the utilities included unlocking access to products that had very high APYs. It was also a part of the ways we could NFT gate products that were maybe more on the riskier side, so that people who were very intentional about staking into those products would intentionally purchase the NFTs in order to access. But our NFTs are traded at a very friendly level, and that is also intentional because we want to use the NFT as a tool to excite the Sega community and the Sega product ecosystem.
Very cool. So, kind of a few last questions here, just wrapping up. So, when you guys are not working on Sega Protocol or market making, what are some things that you like to do for fun? Maybe we'll start with you, Arisa.
Sure. This is on my Twitter, but I read a lot of manga. I would say, and maybe some people can DM me after this if they hear this, but I probably read the most manga out of anyone in the crypto sphere. And on average, I read around 20 to 30 volumes a week. I cover most genres, and I compile a Twitter thread that has been ongoing for around like a year now on like my manga recommendations. And what I love about manga is it really, I think it is one of the most like creative outlets for different story arcs. And a lot of like Netflix shows, for instance, I feel like I can already see what's going to happen with the shows because I read so much manga, and every volume is pretty light, so like I can enjoy it at my own pace when I have a quick break. So definitely love manga. If you ever want any recommendations, let me know. My favorite is Loan Shark Ushijima, which is about a loan shark, and it makes you think about the financial ecosystem quite a bit. And then outside of that, I also angel invest, and I'm very energized by talking to a lot of founders in this space.
That is great. And what about you, Jean-Pascal?
Well, in terms of what I do for fun right now, I just had my first baby about a month ago, and I'm having the best time changing diapers and seeing her become an amazing young girl. I know it's very cheesy, but yeah.
Congrats.
And before that, and hopefully soon again, I love surfing and running, and when I'm not enjoying the Paris restaurant scene with friends. So pretty balanced work life.
Very cool. And then just last question here. Either of you have favorite options books that you would recommend?
Trading Volatility. that was my Bible for like the first 2 years.
The Ewan Sinclair book? Yes.
Yeah.
Absolutely. What about you, JP?
Yeah, actually I do have one. Let me show it. It's gonna make for good advertisement. So the guy is a friend, and it's the best.
Cool.
Stochastic volatility modeling.
Oh, that's fantastic.
This one is very nice, just because it's not just formulas, even though if you like formulas, you're gonna love it. But also there's a lot of like real life example, and it's been written by someone who's been interacting with traders a lot. So there's this connection between the theory and the practice of trading, and to me, it's really the best out there.
Very cool. Well, you guys heard it here first. Thank you so much for coming out to our podcast. I think this is very interesting. To everyone who tuned in, we'll see you next time.
Thank you, Greg.
Absolutely.
Thank you, guys.